Hello all, welcome to www.bspsolutions.com. We are starting today the webinar on financial planning using Excel. The webinar series will actually focus on how can we do financial planning using Excel. This will involve leveraging Excel's powerful tools and formulas to create, analyze, and manage financial plans. It helps individuals and businesses track income, expenses, investments, and future financial goals efficiently. Excel's flexibility allows for customized financial models, budgeting, forecasting, and scenario analysis. To help you understand, let's say Tom has recently launched a small online retail store. Okay, now he has a basic understanding of finances, but he struggles with structuring the financial statements. He finds financial jargon confusing. It is difficult to track income, expenses, and profits effectively. So he would need a simple yet effective way to understand his business financial health. Hence, to overcome all these challenges, we resort to Excel financial planning so that he'll be able to build financial statements from scratch using Excel to track business performance and make informed decisions. The objective of the webinar The objectives of the webinar is to make you understand financial planning basics. We'll cover the key financial concepts such as budgeting, cash flow management, savings, and investments. We'll see the Excel tools for financial planning. So you learn how to use formulas, pivot tables, data validation, and charts for financial tracking. Scenario analysis and decision making, whereby using what if analysis and sensitivity analysis so that you'll be able to make informed financial decisions. And finally, automating the financial reports. So you learn the techniques to streamline financial reporting using Excel macros and dashboards. So your key takeaways would be mastering in Excel functions like SUMIF, VLOOKUP, if formulas, and other financial functions. You learn how to create dynamic financial dashboards. You'll have hands-on experience in financial data visualization and forecasting. And you'll understand risk management through financial modeling. So let's start building our dynamic 3-statement model, where we'll be linking the balance sheet, P&L, and the cash flow statements. Now to start with, you should have a basic knowledge of income statements, balance sheet, cash flow statement, which is the major key financial statements for analyzing companies' health and performance. Firstly, we have income statement, also known as P&L or profit and loss statement, which shows the company's profitability over a period, let's say monthly, quarterly, or yearly. There would be key components here as revenue, that is the total earnings from selling goods or services. Cost of goods sold, that is the direct cost which is related to production. gross profit, operating expenses, EBITDA, net profit. Now income statement, this is important because it helps stakeholders assess if the business is profitable or operating at a loss and where costs can be optimized. Next, we have balance sheet. It will provide a snapshot of a company's financial statement at a specific point in time. It will include key components as assets, liabilities, and equity. It shows balance sheet. It shows whether the company has enough assets to cover its debt and if it is financially stable. So again, it is the core statement. Now the third is cash flow statement, which will track actual cash movements, showing how cash is generated and spent. Key components here would be operating activities, that is cash from day-to-day business operations like customer payments, salaries, rent. Investing activities, that is cash which is spent or earned from investment, that is buying and selling of equipment, property or stocks. And lastly, financing activities, that is cash from investors or lenders, loans, issuing of cash which is received by loans or given as a form of loans, or for issuing stock, dividends. Now again, this cash flow statement, this is also very important because see, a company can be profitable on paper, that is on income statement, but still it could be running out of cash, which is depicted through cash flow statement. It will ensure the liquidity is managed properly. All of these three statements are interconnected. The net profit from the income statement flows into retained earnings in the balance sheet. The cash flow statement adjusts the net profit to reflect actual cash received or spent. And the balance sheet, it shows the company's total financial position, including changes in cash and assets. Thereby, these three statements become very important, as well as they are interrelated. So picking up the same example, as I have earlier told you that Tom, who has started he's done a startup. Now let's see the financial statement which he has, and we will be creating the financial figures which he has generated by operating the his enterprise. And let's see how do we create the financial statements, how do we do financial planning from basic. So this is Technowave Limited, a mid-size IT company. It is a startup by Tom, and he is not he has done the business. Okay, he knows how to do the selling, but he doesn't know how to account for the profits, how to make financial statements. So we'll help him in do so. Here you will find profit and loss statement, okay, or comprehensive income statement it is also known as. Now we are planning budgeted figures for the year 2025-2026, and we have the actual data of the year 2024. There are certain elements over here. We have got revenue, cost of sales, then expenses, you can see over here. Now below here we have the assumptions. These assumptions are based on the market trends as well as on the historical data. This is the basis of these assumptions are the historical data that he has already worked a year, he has given the results, he has done the generated revenue, there was expenses. So on the basis of those figures, the historical data we have calculated, as well as on the basis of market trend, we are doing these assumptions. Now this is a IT firm, so here the billable hours, revenue from contract with the customers, will be calculated with the help of billable hours and the billing rate per hour. This is the assumption for the year 2025, and this is for the year 2026. We have made the assumptions, the rate for cost of sales, that is all the expenditures over here. You can see the assumptions. Now let's start calculating the figures here. So first we have revenue from contract with the customers. So billable hours multiplied with the billing rate per hour would give you total revenue. Once I calculate total revenue, the rest of the figures, it comes automatically with the rates which is provided over here. Okay, now let's see cost of sales. Cost of sales, this is the percentage of rate this is the rate of cost of sales multiplied with the revenue. So this is your revenue multiplied with your assumptions. This is the rate of cost of sales. In case you have over here bifurcation of this cost of sales into the elements like salaries and the licensing cost, then you can multiply the revenue with the respective rates. I have totaled this up. This is 40%, and I am directly taking out the percentage of the revenue. Since this is an expenditure, you have to make it as minus, negative, so that the formula over here, this is the sum of the above all the cells. So this would calculate the gross profit. Here is sales minus your cost of sales. So over here it provides you the exact figure if you are using negative. In case you do not want to make expenditure as negative, you can change the formula. Okay, then it will be revenue minus cost of sales. Coming here to depreciation. So here in the balance sheet, over here we will be coming later on to the balance sheet, and I'll show you the fixed asset we have is of 5 lakh and the rate of depreciation is 10%. So on the basis of that, I'm going to calculate depreciation on the fixed asset amount, which is 5 lakh. And being expenditure, again the cost, actually it is a cost to the company, so this will be negative. Now we have got all the figures. Tax is calculated on the basis of revenue and the rate provided here, it is 15%. So over here the total revenue multiplied with the rate of the tax, you're going to get the tax figure, and again this would be in negative because this is also one of the expenditure. Interest part will come later on. Now similarly we'll calculate the figure for next year 2026. We have calculated the revenue and the cost of sales rest all the figures are coming up automatically, picking the rate that we have provided. And the rate of depreciation would be similar again here. It is 10%. So we'll come to this depreciation part later on. Okay, now this we have finished some part of the income statement, and the depreciation for this year I will make you understand once we go to the balance sheet, and interest part also we'll do once we start making the balance sheet. So here with the assumptions we have finished our income statement. Now let's go to the balance sheet. Over here in the blue you will find actual figures, so that is why I have differentiated it, so that you don't get confused. This is the actual figures. This is the 2025-26 we'll be estimating on the basis of this actuals. So I have hard coded all these figures. Below it here, over here you will find the assumptions. Now again the blue ones are on the basis of actual. So net revenue for 2024 we have the actual figures, taking out the percentage of accounts receivable. The percentage formula is accounts receivable divided by the revenue of that particular. Similarly, accounts payable, the formula would be accounts payable divided by the cost of goods sold. We have calculated the rate of accounts receivable and accounts payable. Now we have some debt. So debt repayment we have done of 10,000. Let's see the debt amount. We have long term debt over here of 2,50,000. For that we have done the repayment in 2024 as 10,000. The rate of interest is on this debt, long term debt, is 8%. Now quickly we'll calculate the other figures over here for our planning purpose for the next 2 years. First we have property and equipment. Now we have the property of costing of 5 lakh. Here, since our depreciation is 10%, this has been calculated and this is in negative. On the basis of this, the same historical data, on the basis of this we have calculated, we have taken the same rates. Okay, the assumptions which we are taking for the rates of accounts receivable and payable is same. You can carry forward the same over here. Now you're seeing here net revenue, this we have already calculated, so it is coming from the income statement. Even the cost of goods sold we have already calculated in the income statement. Both these are coming from the income statement. Now we'll quickly calculate the other figures over here. Property and equipment will be the closing balance of your previous year. That means over here this is your closing balance. Now there is accumulated depreciation which is 10%. So on the closing balance of this 4,50,000, this is closing balance of 2024. This we have picked for 2025. On this we'll calculate the accumulated depreciation. And we'll make this figure as negative because this is a cost and we have to deduct it from the assets, fixed asset. Similarly, we'll work the same for your 2026. The closing balance here becomes the opening, and on this we're going to calculate 10%. Now accounts receivable, I have here written down the formula. It is revenue multiplied with the rate. That means you have net revenue over here coming from your income statement. Multiply this with the rate, your assumption. We'll copy the same for the next year. Now you can see over here in issued capital, this is capital, so this will remain intact for all the 3 years. And this is retained earning, which we will bring from your income statement later on. Let's calculate long term debt over here. Right now it is 2,50,000. If we see the borrowings over here, this year we were already having 2,50,000 as shown over here in the historical data. This was a repayment. Now again in 2025 we are assuming that we will be needing more of cash, so we will be borrowing 1,50,000. Okay, now here this repayment for the next year will increase because this will include your 10,000 of the last year as well as 10,000 which belongs to already existing borrowing, and the new borrowing is 1,50,000. So on the total of this 10,000 plus 5,000. So your net borrowing over here becomes your existing borrowing plus any new borrowing which you have done and minus the repayment which you have done this year. Same goes for your next year also. I guess the formula here was wrong. I will okay, let me put the formula again. This would be your last year. Any new borrowing this year minus your repayment. Now here accounts payable is the figure which we get from multiplying cost of goods sold with the rate. Here I have written down the formula to simplify for you, and you can find here cost of goods sold is multiplied with the rate. This way we are going to get accounts payable. Now there is one thing remaining over here, which is cash and bank figure and inventory figure. So for inventory we have a complete whole session which is calculated on the basis of cost of goods sold and number of days. So that I'll be taking in the another session. Here I'll just input the figures, and over here first we have to do few things. First we have to find the retained earnings. Still in this income statement we are left with the interest amount. This is the interest on loan. So if you see over here in the balance sheet assumptions, the interest amount is calculated on the basis of your debt and the rate percentage. So here we have already calculated the interest amount. We'll just link the sheet from balance sheet. This is the figure of your interest, and for 2026 this is your figure. So this is your interest expense. So now your income statement is finished. You've completed all the figures except for depreciation. For this year, like for 25, I have given the depreciation of 50,000. Let's check over here. This is the exact for 2025. We'll just input the figure from here itself. So for 2024 it was 5 lakh. After providing the depreciation it got reduced, so this becomes your depreciation amount. And over here also we'll just link the sheets together. So this is actually called linking all the three statements. This is a dynamic model of financial statement planning, whereby we link all the figures in the three statements together. Now our income statement finish, and here in the balance sheet we'll take all this profit which is coming for the 2 years. So your retained earning will be your last year's figure, okay, plus your this year net income. So this will pick from your income statement. This is your net profit. This is last year closing balance plus whatever is the income that you have earned this year. Now this is the figure, final figure over here. Still you see, if you find over here, I have provided a check. For balance sheet there is a check provided so that we get to know any errors that we are doing. This is assets should always be equal to sum of liabilities and equity. So the total of assets, if you see for the year 2024, this is 11,96,500. Similarly, if I total up the equity and liabilities, it is matching the assets. So both the sides, asset and your liability equity side, should match. So if I deduct liability equities from assets, this should always be 0. So here for these 2 years we are not getting the check perfect. This is because we haven't right now provided figures for cash and bank statements. Okay, so here now comes the role of cash flow statement, where we'll find the current position of cash. Now since this is also linked, this is indirect cash flow statement. Indirect method, it starts with net income, which is taken from the income statement, and it adjusts for non-cash expenses and changes in working capital to calculate net cash flow from the operating, investing and financing activities. So if you see here net income, this is coming straight away. I have linked the sheet. if I check this, this is the net profit, and here, so the same figures are coming up over here. Now depreciation, this is also linked with the balance sheet, it is coming straight away, 45,000 and 40,000. Let's check over here, this is the figure for your depreciation. Okay, now here we'll find changes in accounts receivable. This will pick up from the balance sheet, will be difference of prior year and this year accounts receivable. We'll go to balance sheet. So this year's closing balance minus last year, so this will provide you the figure for your cash flow statement. Accounts payable over here, again this is also changes in the two figures from prior year to this year. Here we have accounts payable, so this year minus the prior year, the current year minus the prior year. We don't have any investing activities, okay, we haven't bought any of the new property equipment or any of the fixed asset, we don't have this. Now we have financing activities, we have borrowed loan, so the debt repayment here will again pick up straight from your balance sheet. And lastly is the net borrowing. This all this we have already calculated over here. Now we have to see here, depreciation will be positive, but changes in accounts receivable, this has to be negative. See, depreciation, it is a non-cash expense, it will reduce the accounting profits, but it does not actually uses cash. Now since it was deducted in the income statement, we add it back to show the true cash position. Now this changes in your accounts receivable, there is an increase in accounts receivable. It means that the company has made sales but has not yet collected cash. Since cash has not been collected, it has not been received yet, we subtract increase in the accounts receivable. Accounts payable, if you see, this means that the company has right now it is not paying cash payments to the suppliers, it has kept more cash. So since the company is holding on to its cash, we add it back, that is why here I am keeping it as positive to reflect the increase in liquidity. So whatever we have done in the carry on the figures in the income statement, the effect here will be just opposite. Now debt repayment, we are paying off debt which will reduce available cash. Now since cash is actually flowing out of the company, this has to be negative. And lastly, borrowing, this is new debt, so this is increasing the cash inflow. Now if a company takes on new loans, it receives cash, so we add this amount in the financing activities section. So for 2026, again we will over here from the balance sheet we'll find the figures. Changes in the accounts receivable will be this year, the current year minus the prior year. Changes in accounts payable, current year minus prior year. We'll pick up the debt repayment from assumptions that we have created, and here we do not have any of the net borrowing for this year. So this way I've summed up the whole thing. Net income plus operating activities plus investing and plus financing activities will finally have the net cash flow over here. Now we have got the cash figures. I will input this into the balance sheet. Just link the figures from the cash flow statement. And now we have finished the entire activity. We have linked all the three statement. We'll check the figures. If over here we see total assets 8,83,000, 4,70,500. Here also total equity and liability matches. We have a check provided over here. Assets minus equity and liability on both on here for all the 3 years. This is the actual year where we have the historical data. The actual data is over here. These two over here are budgeted. You see all the check here, it is 0. That means our balance sheet is correct. On the basis of the assumptions, we have created financial statements. Now here we have already linked all. If you find this is a 3D model, because we have already linked all the three statements, so they are all interconnected. In case you find this as a clumsy, because over here you have different sheets, you have another format. The idea behind creating the financial statements would be same, taking the assumptions and all, but if you have number of schedules, number of notes available. Like over here, this is the income statement, the same income statement in another sheet, but you'll find there's only sheet 1. You do not have multiple working sheets. The idea behind this is we going to integrate all the statements in one sheet, and we have hidden the over here we have hidden the columns. As and when we require, we can open up, we can unhide this, and we will be getting all the three statements as well as assumptions. Or if you have notes and schedules also, you can bring all of them here in one sheet, so that you do not have to scroll over to multiple sheets. This is what is linking of all the three financial statements. I've already opened up profit and loss here, income statement for you. Assumptions are over here. We can just, if we need to see and we want to calculate, just unhide it and you'll get assumptions over here. Similarly, we can go on calculating the balance sheet and cash flow. So that's all for today. I hope you've understood how to create from scratch the financial planning, how to do financial planning with the help of Excel. The basic structure we have created today. If you have any queries, you can write to us at www.bispsolutions